Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Hello and welcome to Technical Analysis Explained. I'm your host, Tom Schneider, CMT with NinjaTrader. And here at this live stream, we like to showcase elements of technical analysis and go into a little bit of a deeper dive than we do in our regular shows so that you can be a little more informed and decide, is this something I want to use in my trading? What I'm trying to do is promote to you things that maybe Jim and I use, Mike and I use, but things that we might not use either, but certainly deserve a place at this table of technical analysis. Today's topic is no different, and since it's a relatively new show, we'll be featuring more of the popular indicators first during the series. Today, our topic is stochastics. And stochastics is a general term. It's a type of analysis, right? But in terms of technical analysis, when we talk about stochastics, we're talking about a very specific momentum oscillator that shows up underneath the charts. There are a couple kinds of stochastics. There's fast stochastics and slow stochastics. We'll talk about the differences of both studies. But stochastics has been around for more than a few decades. It's probably late 1950s, early 1960s when it really was developed and discovered. I like to say discovered. But George Lane is probably the name most associated with stochastics. He certainly was one of the people that developed it and promoted it throughout his career. And he's no longer with us. We can't talk to him about that. But the stochastics is a momentum oscillator designed to measure how well this trend is behaving, how momentous is this trend. It is directional, so we will see that on the chart, what I mean by that. And it is a bound oscillator. It is a range-bound oscillator. It ranges from 0 to 100. So the nice thing about bounded oscillators is we can use them to compare one market to another. It doesn't matter what that other market is. So let's get into it. Let's talk about what stochastics is and what it looks like. Now, if you see my chart here, I've got a daily E-mini S&P chart. I'm going to use what you might call the factory settings, but the default settings that George Lane himself tended to use. You can certainly change those, and I'll show you how to do that. But we'll start with fast stochastics because it is really the foundation of the stochastic study. Now, when George Lane and his associates were developing this indicator, they came up with an idea of how to see if a trend is changing, really, is what they're trying to identify. We can look at a chart. We could see this is in a downtrend right now, but how good is that trend? How extended is that trend? How exhausted is that trend? We don't really know, right? I can look at data and I can see that E-mini since the end of July has been in a downtrend, but I don't know if that's where it is on the scale of how extended this downtrend is. But the stochastics might give us some insight. So what George Lane and his associates used was the concept that when a bar closes, it closes somewhere within a range. And what range are we talking about? Well, you could look at the current range of the bar, the bar itself. And right now we're seeing that this bar, this daily bar, we're trading 43.90. And I can click in my software, my NinjaTrader software, I can click on that bar with my mouse wheel and see the range. We see a high of 44.27. We see a low of 43.65. Doing the simple math in my head, we're about 62.5 points on the range. And right now we're at 43.90. yeah, I have to do some eyeballing to see if we're in the lower end, the upper end, or right in the middle. We're closer to the middle than the lower end, but that's not good enough for calculations, and that's not good enough for making an indicator. What we need to do is determine, well, what are we trying to identify? How far along this range we are. And it wasn't just one bar that they looked at, which I think is really important. George Lane and his associates who developed stochastics wanted to look back over time. So if I just looked at where the close is on the range of the current bar, for each bar, I might get wildly different readings. And even if I average them, they might average to a flat line over time if we're looking at moving averages, or something that just doesn't tell us exactly what they're trying to identify. What I think kind of the genius of stochastics is looking at a range over time that moves with each new bar. What do I mean by that? Well, instead of looking at where the close today is on the range of today, it's the stochastic calculation uses the close of today versus the range over time. In this case, let's take a look at our indicator. I'm going to right click and go to indicators. And we'll see that I'm starting with the fast stochastics and the period of the K line. So there are two lines, the K and the D line. We'll focus on the K line because that's where everything starts. 14 periods. Well, what does that mean? That means that we're looking at a range determined by the last 14 bars, inclusive of the current one. So if I bring up a horizontal line, I can hit F12. Let's see, I'm sorry, not F12, F6 on my keyboard. And I can go back and I can really easily see what the low of the last 14 bars is. It's right here. So I'm going to click there to mark the low. And if I bring up another horizontal line, the high of the last 14 bars, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. That's the range we have to work with. Well, the high is right there. So I'm going to click at the high. So now I have a range. And the calculation is what percent is the current price along this range? And that will be our percent K. So what I'm going to do, and I had this up earlier, I'm going to drag this over, is I'm going to calculate. We're going to calculate that with a calculator, right? So I want to find out what is that range. So here, if I click, I see the high is 45, 44, 75. So I'm going to type that in 45, 44, 75. And I just happen to know the low here is 43.50 even. So I'm going to type in 43.50 even and get this value. This is the range of the last 14 days from the high to the low, 194.75. I'm going to put that into memory, and I'm going to see what is the difference between the current price and the low of the last 14 days. That'll basically tell us how far up this range we are. So I'm going to use 43.91.50 because this will move, right? We're looking at this live, but we'll use this as an example, and we'll subtract 43.50 to find that distance. We're 41.5 points from this low. Now, if we divide it by that number we had before, 194.75, we get a value of 0.21 and then a bunch of numbers. Now, if we multiply that by 100, that will be our percent K value. So I'm going to multiply by 100, and we'll see about 21 is the K value, 21 and change. And look right here, this blue label right here is that K value. There's your percent K. So I'm going to get rid of the calculator. We don't need that anymore, and realize that this value right here represents the current price of that bar divided by the range of the past 14 bars, high to low, multiplied by 100, so we don't have to really worry about too many decimals. Now, what's this percent D line? This percent D line is simply a 3-period moving average. How do I know that? Well, let's go to our indicators again. I'm going to go to fast stochastics, and the period of the D line represents the 3-period simple moving average of the K line. So this idea of smoothing data to use when we're talking about oscillators, we're talking about prices, smoothing data to use as an idea of when a trend might be changing certainly is here in the stochastics. So the fast stochastics is simply that calculation we mentioned before. How far along the range are we currently over the range of 14 days? And then a 3-period moving average. Slow stochastic takes that concept of smoothing one step further. So we'll go through the slow stochastics calculation real quick. And I do want to highlight something after we do that. So when I look at slow stochastics and I go to my indicators, and now I have to move down here because stochastics is really the slow stochastics, you'll notice period K is 14, period D is 3, and then smooth I have set as 3. What this refers to is that percent K calculation, look back for the range, 14 periods, and then a smooth version of that, the 3-period moving average, and then a second smoothing. Now we don't show the traditional percent K on the slow stochastics. We're actually showing the smooth version of percent K and then its smooth version. So it's kind of like a derivative twice of the percent K. And how can I really easily see that? It's kind of hard, right, to see it? If I go to indicators and I look at my slow stochastics, I'm going to make transparent what is labeled here as D. And that is the purple line. Let me move this up a little bit. The purple line on this indicator, I'm going to make that transparent so it doesn't show up. I'm not getting rid of the calculation. It doesn't show up. So if I hit apply, you'll see it disappears. Now I'm going up to the fast stochastics, and I'm getting rid of the K line. So if I go to K and I make that transparent, we'll move that up here. We see the transparency. We hit apply, and look at this. These are the same lines. So when you look at a fast stochastics, that smooth line, that's this line right here, the purple line. That is what considered the K line in the slow stochastics. I know it's somewhat confusing, but that's kind of like where you start with slow stochastics and then you smooth it again. So let's bring that back. I'm going to go to my fast stochastics and I'm going to change that indicator, that K line. I'm going to change the indicator to show that we have that K line. And then I'm going to go to my slow stochastics and we'll change that transparent indicator back to the medium violet red, as it's called here. So that's the relationship between fast and slow. Fast is the original version of stochastics. In fact, it didn't even have a smooth line. That was introduced later as somebody took George Lane and his associates' ideas and said, what if we smooth it? And then somebody said, what if we smooth it again? And there's slow stochastics. I prefer slow stochastics somewhat on a longer term chart, but you could use fast stochastics just the same. Now, how are they used? How are we interpreting the fast stochastics? Well, I see right away, I see two different lines. I've covered colored red and green. I've changed the default, excuse me, to show red and green. And you might have seen these kind of in RSI studies. An overbought or oversold line is what these are considered. So in a trending market, you might see that as that trend gets older and matures, that the stochastics spend some time below the 20 level, the oversold level. And as that trend and uptrend matures, you can see here, this trend was going on for a couple weeks, 2, 3, 4 weeks. It spent some time over that 80% level. So it isn't really just about triggers. It's also about states. If I am above 80, I want to know that about my market. I want to know that if stochastics is below 20, that's happening, because that to me is an indication of oversold, and we could possibly return back to an uptrend. When we're overbought, we could possibly return to a downtrend. So understanding that, understanding that overbought and oversold levels are states is a good start. Now, what also happens? Well, because we have these smooth lines, because we have the percent D line in the fast stochastics, and we have this percent DS line is sometimes what it's called, the smooth version of the percent D line, we can use these crossings as signals possibly. There's a nice one right here in July where the percent DS or the percent K in the slow crossed below the signal line right here. That occurred when we started to trend downward. Now, it didn't last very long. It was only 3 or so days and it turned right back around. That's a pullback, right? But this caught it pretty nicely. Now, you're not going to always get the peaks and the valleys, but it could be a way to identify a trend is changing. So interesting to see these even in a pullback, we identified those inflection points. Right now, on the slow stochastics for the E-mini, we've got this cross of the smooth line, and it's crossing below. Well, what happened? We had a little bit of a pullback here. So it's reflected here. In the fast stochastics, that pullback possibly was recorded a little earlier. Maybe that cross happened a day before. So there is differences in the fast and slow, namely when you might get these indications, when you might cross below. Look at this on the fast. We saw a cross below 20, meaning oversold, back in August, beginning of August. Well, it looks like it was a couple days later when the slow caught up. We're a little bit more into the trend, but it also could be that, well, confirmation on the slow is maybe a little more sure that we're in the trend. So that's another way to interpret these indications is when they cross below, but also when they cross out of. So there's a couple crossing things here, crossing in triggers or indications that I've mentioned. It's when we cross below a level on the scale itself, the 20 level. When we cross below, that's oversold. When we cross above 80, we get overbought. I want to know that. But also, when we cross the signal line, that might be an indication that trend could be changing. Now look what happened. We're below 20 and we get a bunch of crosses. We get a cross up, we get a cross down. We get a cross up, we get another cross down. We get one more cross up. So you can get what we call whipsawed, even though we've got this nice downtrend. The fast can give you these whipsaw events. The smooth, they're not quite as pronounced, but they gave you some as well. So it's great to look at, say, wow, we got a cross up, but this is where I might look at other indications. We don't trade indicators in a vacuum. We don't just want to look at one source. So you might look to your Bollinger Bands for volatility. You might look at ADX to see what the overall trend is, the trend strength, I should say. You might want to look at other indicators. And we talk about not looking at a whole bunch of indicators, but sometimes it's good to have one or two that might give you confirmation. I get this signal here, but I don't get it over here. I might wait. So that's one thing that I would caution you about any technical indicator is we don't trade it in a vacuum. Now, what else can we use stochastics for? Well, I see something on this chart that I've talked about in our other shows, but it's I wouldn't say it's glaring, but it's pretty close to glaring. And this is divergence. And so when I look at divergence, I'm looking for a disassociation of price versus the momentum indicator that I'm looking at. And I'll use the arrow line. And you see this general higher high kind of situation we have from the middle to the end of July. We've got higher highs. Now, it isn't always the case. Not everyone is higher, but the trend of the highs seem to be up. Well, in the stochastics indicator, that wasn't the case. If I'm trying to line this up appropriately, we see that those highs, and it didn't work for me. Doesn't want, oh, you know what? It probably thinks I know what happened. I'm in the wrong panel. I have to stretch this out again. Let's do this. Let's go right up here. Try to line it up. It's going to be difficult. And then it's those highs are going down. So that's divergence. Ideally, I think George Lane's own writings, he's looking for divergence above and over an 80 level, an overbought level, or underneath 20, and then some sort of crossing event. It's kind of like a 1, 2, 3 divergence, oversold or overbought up here, oversold down here, and then a crossing event. And that was kind of his guidelines for using stochastics. So a lot of things we can use stochastics for. We can use them for bias. Are we oversold or overbought? We can look at them for trend change. Are we getting some crossing events? Could this trend be changing? And then divergence. A little bit longer, but it might be important to know if the momentum is telling us that, hey, this trend is running out and it's correcting course, even though we're still above 80, even though we're still under 20. If we're not getting the same strength of movement of upticks up here or downticks down here, there might be some divergence and course correction is coming. Now, it doesn't always happen, but it's one of those things. It's like an alarm. You want to know when it's happening. And divergence is a little bit harder to codify. So it's something you really have to check the charts for. Now, how can I use it aside from being in the charts? Well, I like to put indicators in my market analyzer. And the reason why is if I have a lot of instruments I'm following, not necessarily trading, but following, market analyzer is great for that. I can look at the current price. I can look at how much it's changed overnight from last night. The volume, right? Volume is really important. It's confirmation. So I want to know the volume. But I can also put in indicators. And I've done that with the average true range up here. But let's say I want to know if something's overbought or oversold on the stochastics, and I don't want to go through every chart. So I can come here to the market analyzer, and I can right-click, go to columns. And in there, there's a lot of stuff in there. There's a lot of real-time data or kind of calculated data. But if I go down, you'll see indicator. And this opens up all the different things I can add in terms of technical indicators. So I can hit add down here, and that makes this live. Now, default is kind of the first study in the list on 1 minute data. Well, that's not what I want. I want to actually find, we'll go to fast stochastics. And we scroll down here, it's actually stochastics fast. And what do I want to plot? Well, I'll plot the K value, the first value. And I leave the parameters as they are, 14 and 3, but I do want to change minute to day. So I want to base this off of a daily chart. I'm going to scroll down to calculate on each tick. And let's just see what happens when we apply that. Now, doing the calculations for all my studies here. And it was pretty quick. You can see this column right here. I'm going to move this over maybe, see if I can do that. Nope, I'm still in this box here. And I see the label. I'm just going to call this STOCHA, kind of slang or shorthand, I should say, for stochastics. So now it shows up as Stokes. I can even put in daily. If I'm not familiar, I just want to make sure I'm looking at daily data. Let's see. Okay, so it shows up here. Now, notice my fast stochastics is at 26, and my K line here is 30. There's a little bit of a discrepancy. Why is that? Well, let's go to our indicators. On the chart, that is, and let's pull up our fast stochastics. And let's see, maximum bars look back. Okay, that's interesting. 14 and 3, that works. Calculate on each tick. Okay, that's great. Let's hit OK, and let's come back here. And let's see where we can debug this. And let's go to Stokes Daily. And let's look at, let's see if this, let's say 0 days back. Let's see what happens there. Does it calculate? Do I need to have a value in there? Maybe I do. This is confusing me. So I'm going to go back to 1. Maybe I need 2 there. Now we've got ES 3098, so we're getting a little closer. And I think I know what it is. It's not days, it's bars. So bars to load, let's change that to 256. Let's see if that works. Let's say, okay, come on, chugga chugga. Calculating, it's doing a lot of calculations. Oh, we're a little closer. 2734, 2734. I think we're spot on. 2721, 2721. So this is what will match your chart. This is the current value. So interesting, I guess, right? Nice, but we can take this one step further. We can actually color code. You'll notice my percent change is color coded into positive, negative. It's green if it's up. It's red if it's down. Okay, if the market's up, we're green. If we're down, market's red. Market's down, we're red. I want to do the same for stochastics, except I want to add a condition that if it's above 80, I'm going to put in a green background. And if it's below 20, I want to put in a red background. So how do I do that? Well, if I come over to my Stokes Daily configured column, I scroll all the way down, conditions. First thing there is sell. I'm going to click on add condition. Nothing there, but if I hit add, it fills in my qualifiers, my trigger, if you will, and then what'll happen when that triggers. So color for background, I'm going to make this, let's say, dark green is pretty green, pretty dark. I'm going to go to, let's say, lawn green. And I think that's the color I used here. And then I'm going to apply to all cells in this column when the column is greater than or equal to 80. And we'll hit OK. And now, do we have anything greater than or equal to 80? Well, heating oil is, so let's see why that's not working. Let's come back and let's do this. Let's do it for the less than. We're going to change it to red, or let's say a light red. Well, we'll do red. If it's greater than, or less than or equal to 20. We'll hit OK. Let's just make sure. Now we should have some. Let's hit apply. And let's let it think. Hopefully it'll show up in just a moment. There we go. It just took a little bit. So now what I can see right now, I can see, first of all, there are more reds than greens. So the market overall seems to be oversold. I can look and see which markets are oversold. So I can see, oh, the Dow is oversold. Well, let's take a look at the Dow. And that's the E-mini Dow, I should say. And look at that. I can see my stochastics is under 20. And it just got a trigger signal crossed above its signal line. So that might be interesting. I might be interested. I do further research on the Dow. Oh, look at this. Heating oil, 99.22. Wow. Let's take a look at that chart. We don't look at that too much on our regular shows. Well, I mean, it's been pretty bullish, right? Look at that. That K value is 99.91. It's trading at the top of the range of the last 14 days. So very, very informative way of using stochastics in the market analyzer, I think, is color coding, because that can help you get a general sense of what the market is doing. If you see a lot of white, nothing's really overbought, oversold. You see a lot of green, you know things are overbought. Maybe there's a correction, or we're just in a really nice trend. You see a lot of red, again, oversold. Let's see if that's going to continue or if it's trying to get back up. It can also help you pinpoint which markets you might be interested in. So I can take a look and say, oh, currency futures, a lot of red here. Oh, look at that, Mexican peso. Let's take a look at the peso. Or interest futures. Look at this, two-year August 23 contract. Look at this, 5-year, 100. Wow. So the market analyzer can help you be a little more efficient, especially when it comes to your indicators. Stochastics is no different, and it's a great overbought, oversold indicator. And it's great for understanding possible reversals when you talk about those crosses, especially if you're above 80 or below 20. I hope this was helpful. If you have any questions, you can send them to me or anybody here at NinjaTrader at learn@ninjatrader.com. I'll be happy to answer your questions. Thank you for your time, and we will be back next time in 2 weeks to tackle the next technical analysis topic. In the meantime, have a great trading day.